So, David, we know that there's a couple just high level goals that if a beginning investor would say, I know that I want to accomplish these types of things without being real sophisticated, they can identify those. So the first one that we've talked about before is that idea that how do I know that I'm getting good growth over time? How do you ensure that that happens? Can you give us some insight there?
I can, but the reality is not everybody's looking for growth.
Well, that's true.
Individual clients may have different needs. Somebody might be more focused on income.
Yeah.
Somebody else might be just simply preserve the assets that they have. And others, in fact, most probably would be looking for growth. It seems to me it's first trying to understand the client's situation and then construct an appropriate portfolio, figure out the right levels of risk, standard deviations, thinking about how much volatility to take on. And frankly, probably the most important is what is the rate of return without regard to how it's generated, appreciation, income, etc. What is the rate of return necessary so we don't run out of money?
Right. I think that is a good point, that at the end of the day, that's what most people are trying to accomplish, that sense of security, that I can make it through my lifetime, I can live the lifestyle I want to live, and I know I need my portfolio to be a big player in that. So what are some of the things that we do to ensure that we get that support from the portfolio we need for that lifetime goal?
Well, I think it really starts with the overall plan. For example, somebody who's 30 years old may approach this very differently than somebody who is, say, 70.
Sure.
If you're 30, inflation is a significant risk that is often overlooked. I mean, over 50 years, the loss of buying power is meaningful. So you have to grow at a rate, at least inflation or better.
Yeah.
Whereas at 70 or 80, it's less important. Just preserve the assets and generate the income or whatever income, whatever needs you might have. But I think it's ultimately first understanding your situation, your time horizons, and frankly, how important is it that there is a legacy, a level of assets left over at the end of your plan, as we so often speak of, for your children or philanthropic interests, whatever it might be. Because we can work our way back. It's one of the, if I'm real frank with you, I think that's one of the most valuable things that we do is help people understand the consequences of decisions. Thinking through decades into the future, because we have some really sophisticated modeling to take into consideration inflation rates, market volatility, a variety of factors, and then take into consideration average or reasonable rates of return for different periods. How does this all work out? What's the probability of success is the simplest way of saying it.
I think you're making the great point that I think what makes us kind of distinctive is the way we look at the marriage between your portfolio arrangement and management and the overall plan. One is tied to the other, that we have to make sure both are successful. You can't separate the two.
100%.
Yes. And frankly, these are some pretty big ideas that we're presenting that go much deeper than a short conversation we could have today. And so the encouragement that we would give to you is take some time to talk with your McKinley Carter advisor. Understand how your investment needs to be structured so that your financial life plan is a success.